Welcome back to the Thinking Crypto podcast. With me today is Greg Dickerson. Greg is no stranger to the show, and we're going to talk about the Fed, the markets, and much more. Greg, great to have you back on the show.
Hey, Tony, great to be here. Thanks for having me.
Well, Greg, we've certainly been talking about the Fed and for a while, for months, and we got another rate hike announced today, 50 basis points. What were your takeaways from what the Fed said?
Yeah, it was pretty expected. He telegraphed his last conference or last speaking engagement that he anticipated a slower pace of rate hikes as soon as the next meeting, which was this meeting. So that was expected. The markets priced that in. The two things that were not expected that surprised the markets were the new Fed funds target, their new terminal rate, 5.1 to 5.5. That's still another 75 to 100 basis points from here. So that was the one surprise. The second surprise was he basically drew the line and said, we will not be cutting rates in 2023. That rates are going to continue to rise. He didn't say at what pace, how fast or any of that. He just said that although we've made progress with inflation, we still feel like financial conditions are somewhat loose. They need to get to more restrictive, and they need to keep rates higher for longer into next year. And they're not anticipating any kind of cuts at all going into next year. So if you read between the lines, what that tells you that they're thinking is they're not anticipating inflation coming down below probably 4 or 5% next year. So that's kind of what that means by them saying we don't anticipate any rate cuts at all. He didn't even say anticipate. He just said, we're raising rates through 2023. He didn't even say anything about a rate cut. Didn't indicate that at all. So that tells you that they think and they believe inflation is going to be higher for longer. And the reason is because the labor market is so tough to crack right now. They haven't been able to make any headway in the labor market. So he spoke about that today. And, I think they need to see at least unemployment rise 2% from here before they see any real headway in that market. That's keeping obviously prices higher in the service sector. So that was a big concern for them. And then the other one was rent and housing costs. Housing is still too high, even though housing prices have come down. Right. The levels that they reached after the pandemic over the last 6 months to a year were such distorted levels that even where we're at now are still way too high. And rents. So they fully understand that there's a lot of in-place rents that are going to increase when those rents come up for renewal. Although he did say he's seeing some rent reductions in some areas, but again, those are from very distorted levels where rents were pushed to extreme levels, and now they're backing up a little bit. So even though they're backing up, they're still way higher than where they were even a year or two ago. So they recognize they've got a lot of work to do.
So on that note, they did reduce the amount of or the percentage of rate hikes, right? Before it was 75, now it's 50. So do you think they're going to do maybe quarter, 0.25 in 2023 in different increments?
Could be, but that's not even really the issue now. So rate hikes are out. So the markets have priced in interest rates because they know where they're going. I think the biggest thing the Fed's going to realize is, and what they've done each meeting is they've raised their target terminal rate. So it's a possibility they may need to realize that they have to go even higher once we get into the next meeting, which is February. Oh, wow. Potentially, depends on where inflation is, that kind of thing. But the markets have priced in interest rate risk. They're pricing that in as it goes along. They're pricing in, the Fed's response to that and interest rates. What they haven't priced and what they can't price is earnings and recession. So now where the Fed hiking and all that, that's done. That's over with. 50 basis points is huge. That's a significant rate hike. So, will they go 50 next time? Will they go 25? Markets don't care. What the markets are going to start looking at now is earnings and recession. So that's going to be the big discussion going into next year. Right now, we got the all clear. We know what the Fed's doing. We know what they're targeting. Now it's all about Wall Street wanting bonuses, little Santa Claus rally and those types of things. So I think, the markets might, pare down a little bit the rest of this week potentially. And then if you look at history of the last couple of years, the market rallied right into the end of the year and then dropped off in January, February. So I've got some historical stuff. We can look at that in the charts in a minute and how that relates to Bitcoin and what happened to Bitcoin last year and in 2018 after the 2017 top. So pretty interesting timing.
Now it's always big discussions and conspiracy theories and dialogue back and forth about what the Fed's going to do, and everybody tries to predict. But do you think they can continue raising, even if they reduce the volume of rate hikes into next year, or will they have to pause because there's other implications as a result? They could take us on the other side of the hill where deflation and all those things and level, maybe depression levels. I don't know.
Yeah. I don't think depression right now is on the table or anything near that, levels in the markets or anything like that. I think the economy is still pretty strong. The consumer is still pretty resilient. Wages are still going up. The labor market is still very unbalanced. There's still twice as many jobs as people willing to work. So right now, there just are no indications we're going to have a huge recession. Now, a bunch of CEOs and economists are saying that we are, and they're seeing it in their businesses, but that's just because prices are so high. People are kind of pulling back in certain areas, and because prices are so high, companies are still profitable and they're still showing growth. So a real recession is job losses, companies going out of business, bankruptcies, things like that, markets dropping 20-30% from here. Is that possible in 2023? Right now we just don't know. We're going to have to get into next year, and that's when those debates and discussions are going to happen. The Fed can't stop. They can't cut until they get inflation down. They just can't do it. And that's what Powell has said today. The markets still don't believe him. That's why the markets are where they are. And you didn't see, a huge drop today. You saw a little bit of a drop. But the markets, they're not buying it. They don't believe the Fed is going to do what they say they're going to do. And the reason is because they don't have any credibility. I mean, the last meeting, Powell, told the markets, hey, we're going to slow down the pace of rate hikes when they should still be raising another 75 basis points. They haven't really, brought housing down. Financial conditions had eased significantly. The markets were up, yields were down. Rates were down. So that's, bringing mortgage rates down, which is putting more pressure on housing. The dollar's down. All that's inflationary. So the real issue at hand is the labor market and inflation. And the Fed can't do anything until those two things correct. And that was the third thing that, we already talked about that. Well, really, what they did say was the 2%. So they're not, like, there is debate. Is there going to be a new normal for inflation? We're going to target 3 or 4% as a new normal for inflation. He said, we're not coming off 2%. So that was the third thing that he surprised the market with, was saying that we're targeting 2% inflation. We're not coming off that.
So yesterday we got the CPI numbers. They came in lower than expected, and Bitcoin had a little bounce. Maybe you can show us on the charts what you're seeing and what you're expecting for your Santa Claus rally, as well as, could we go lower in January?
Yeah. So, a lot of what's going on with the markets is algorithmic trading. And, this pop in Bitcoin here, a lot of people were short. This was, options and things like that. So, there was a lot of bullish divergence in the RSI, things like that. So this was due. This little pop was due. And we've had it at the end of every single little Bitcoin, consolidation in Bitcoin here lately, with these last drops. As it levels itself down, you get these nice little pops right before that last level. And the question is, when that reversal happens and we start testing the lows of the range, the real question is, is this now, right here lately, it's been 16,800. So the question is it going to stay there, or is it going to, drop down and kind of range in that, test that 15,000 level and range, there again? And what's interesting is when you look at the price action of Bitcoin, so if we go back to December of last year, right here, where's December? Right here. So this area in here, this was the first part of December, but here's where we are right now. So today's the 14th. So December 14th was right here, right at this point, right in this area. If you can see that was December 14th right there. And then, had a little pop, markets dropped down, and then started working its way up from the 18th on. And that was about a 15% price increase from the bottom, up into the end of the year. So this was Christmas. It was actually down. And I remember this on Christmas Day last year when this was happening, and the markets were just straight down from there. Of course, that was in the Fed tightening cycle. Inflation was getting out of control. So, everybody knew the market was over right there. But basically from this point on, it was pretty much uphill after a couple of days of down. The interesting thing is if you go back and look at 2017, 2018, the last cycle, December 14th is right here. So right in this little area here, we'll just kind of draw a little point there. This is the 13th, 14th right here, and it kind of bottomed for the range and then had a 30% bounce into Christmas, and then started working its way back down to that double bottom before, coming out of it. Now, again, this was a macro bull market. This was the Fed pivot when all that happened. And if you look at, let's go ahead and look at the S&P, during that time frame, that was when, what are we looking at? 2018 right here. So this was that same time period right here. The last time the Fed, last time the Fed tightened was right in this area at the end of 2018 going into 2019. And that was the Fed pivot right there in December 2018. And it was all uphill going into 2019 from there. So this was Fed tightening cycle here. Credit markets broke, froze up, and the Fed pivoted and started cutting rates, and you're off to the races. So that was the Bitcoin bottom of that range. That was the market's bottom of that range, except the markets kind of went on and went up from there, whereas Bitcoin double bottom.
Right. I remember that. I remember that rally to like 16K. I remember seeing that.
Yeah. Yeah. And I wasn't in the market back then, but I was watching it. And, it was very interesting. And, so the question is, where is it going from here? I think we may have found a nice little macro range that Bitcoin's in. That 15.5 could be the low right now, as long as nothing else happens. And when I say nothing else, I mean a major financial market situation where we get a collapse in traditional markets. If we can stabilize, and if markets can kind of range and carve out a little bottom here, maybe range down to that October low again, and then kind of just range in this area, sniffing out recession and earnings and things like that, then Bitcoin can definitely find a range. Ethereum can definitely find a range here on these lows and kind of stabilize and start consolidating for the next bull market. But if we get if Binance ends up being a problem, if Tether ends up being a problem, and we find out other things through this whole FTX situation, and other things get exposed and crack, that can obviously take it down. And it can take it down to levels much lower than people think.
Below 10K, you think?
Oh, yeah. I mean, the last 4 years, it's dropped down to 3,000, 3,500. So there's no reason to believe it can't do it again just because it hit 69 or 64, So, I mean, it can go lower than that. I mean, if you get a if Tether blows up and Binance blows up, it can go pretty low. And, people will back away. Now, there's a lot of other people in the space now, like you and me and, other investors that, will step in. But, if Tether blows up and Binance blows up, I'm going to stand back and just watch and see how low it gets, and then I'll jump in at some point because it's not going away. That Bitcoin is not going away. It can go down, it can go to zero, but it's not going to stay there and be worth nothing and go away. It will come back. I don't know if it could actually, anything's possible. I don't know if that's actually possible for it to hit zero. I think there'd be enough people buying to where I don't think it would ever go there. But the last 4 years, we've seen 3,000, we've seen 3,500. So it can go there. And that was in a macro bull market with a lot of institutional participation in the space when it hit those numbers.
Yeah, it's a good point. So are you, if you don't mind me asking, are you like dollar cost averaging now and keeping some dry powder for if it goes lower?
Yeah, so I'm still cash. And just to clarify, I'm not saying that that's in the cards, that that's in the charts, or that's anything that I'm thinking is going to happen. I'm saying if Tether blows up, Binance blows up, then you got a pretty good chance that you're going to see those levels. But no, I'm waiting. I'm just kind of watching the consolidation. I'm not comfortable. I still think there's problems with Tether and Binance. So I want to see that dust settle because, if it drops down to 10,000 or 5,000, that's a significant amount. To the downside that I could take advantage of versus the potential for exponential upside right now is pretty slim.
Now, you've been talking about in your content a Santa Claus rally. What are you expecting for stocks and even, Bitcoin and the crypto market? Could we
Yeah.
see something next week?
Yeah. Well, started.
It
So if
started
you look
already.
at if you look at the last couple of years, it all started that week before Christmas. And, last year in particular, we got probably a 7 or 8% rally in traditional markets, seven, in the Dow, I think it was, 8 in the S&P and NASDAQ. Bitcoin got a 15% rally. Then it was downhill from there. We've been downhill ever since, but
Got
you're
it.
getting bounces. The difference is now, I think the markets understand and have digested inflation risk. They understand and they've digested interest rate risk
Mm,
because it looks like inflation has peaked. Um, I'm
right.
not sure we're going to get a double top and a revisit, in inflation because commodities are coming down. A lot of things are coming down. And the Fed has showed, with raising today that they're resolved about fighting inflation. So I think we've seen inflation peak and we've plateaued. We
Mm.
haven't come down enough for me to get excited and say, okay, it's bull market on. And it's not just me, it's the Fed. So the Fed's making it super easy. They're
Can't fight
telling
that back.
you, they're telling you, hey, if we're tightening, you need to tighten. You need to pull back, and it's risk off. And then when they tell you we're going to stop and we're going to, maybe when we can start cutting rates, then it's risk on, and you can start, jumping back in the market. So I'm just following what the Fed is saying and doing because it's liquidity.
Yeah.
The other thing is to keep in mind is there's a ton of capital that has to be put to work. So capital has to allocate. There's pension funds, there's life insurance companies, there's institutional funds, sovereign wealth funds, family offices. They have to put capital at work to pay
Right.
premiums, to pay dividends, to pay claims, things like that. So there's a lot of capital. I'm talking hundreds of billions of trillions of dollars on the sidelines that needs to go to work at some point. So once we get a little bit more, clearance and get through the end of the year and things like that, I think that's why you're going to see some of that start coming in next week, to get that little Santa Claus rally because Wall Street needs their bonuses. Capital needs to allocate. So we've driven down. We might go down a little bit more next couple of days, and then going into next week with Christmas being on a weekend, we might see a big week next week, and then bam, downhill the following. After that, and kind of work these ranges. And then that's where Wall Street makes a lot of money is when the markets are doing this.
Sure.
And the most money to be made is going long, right? 90% of the investors in the market are long. But, I don't think we can do that until we understand recession risk going into next year and, earnings.
So, similar to, Bitcoin and crypto, you're not scooping up any stocks right now. You're also in a holding pattern, just watching what's happening.
Trading ranges. So I'm just trading ranges. I'm doing some tax loss harvesting, things like that. So I'm just kind of goofing off, playing around. I'm not long anything right now. I mean, I look for major lows, to go long, and that was 2009. Big, long entries into the market. That was 2009. That was 2020. So, last year about this time, I think, were you and I talking? I can't remember what our first interview was, but, last Thanksgiving and Christmas, I was in my circles. I was like, markets are done. It's time to get out and go to cash. I've been cash ever since, just, trading the ranges.
Mm.
Yeah. I don't dollar cost average. That's not a strategy I've ever employed.
Okay. So you're just trading, swing trading and so forth.
Yeah, yeah. And, and the reason for that is, when you think about dollar cost averaging, it really doesn't make any sense. If you're a long investor, that makes zero sense. Now, on the way up, it can make sense.
Okay.
On the way down, it doesn't make any sense because you're wasting powder, your dry powder on the way down. So what you want to do on the way down is you want to buy those dips, sell the rips, buy the dip, sell the rip, buy the dip, sell the rip, because, Bitcoin's at, 18,000 right now. So if you bought it at 15, you made a nice little burn, get rid of that, because if it drops down to 12, 10, 12, you can buy twice as much and then, kind of do it again. And then, where you dollar cost average is, on the way up. You buy the dips on the way up and hold, and kind of ride the bull market momentum. So that averages your basis as and increases your holdings as you go up. But going down, I mean, yeah, if you're losing money and you say, hey, I bought it at 50 and I want to reduce that basis as I go down, and that's your mindset, I guess you could do that. My mindset would, is a little bit different on that. And, you kind of want to lead that market down, sell the peaks, and kind of work it that way so that you have all your dry powder ready for when that thing bases, and then you can go in and make bigger moves.
For sure. On the real estate front, home prices have fell, applications for mortgages and refinance as well. What are you doing as a builder and as an investor?
So on the real estate front, you've got a lot of carnage out there right now and a lot of stuff lurking under the surface. So I'm waiting for, some distress in the market. So there's a lot of commercial loans that were made, bridge debt the last couple of years that are resetting. So there's a lot of, distress situations coming down the pipe because of interest rates, and rates have come down a little bit, but as the rates go higher, there's going to be more properties in distress. But I'm not interested in real estate right now because prices are they went through the roof too fast. They haven't come back enough, and interest rates, nothing works with today's interest rates, the building costs, interest rates, all that. So, I've got some people that I'm working with that are doing some stuff, but, right now for me, it just doesn't make a lot of sense.
Yeah, for sure. So, you think it's a rough Q1, Q2 in 2023, and then maybe the second half of next year, things get a bit better overall?
Yeah, I think our real risk is stagflation. I think we're going to see high interest rates and slowing growth. I think that's kind of what we're looking at going into next year. I really have no idea what a recession is going to look like, what it can look like. I just know that things can pop up that we don't anticipate that can drive stuff, way lower than we think it can and deeper than we think it can. But I don't see a depression. I just don't think that's even possible. With our economy, we're such a globally connected economy right now. There's so much consumption going on. Even during the pandemic, the economy still hummed along pretty good, sure, even with a mandatory shutdown. So, that showed you right there that the economies around the world are pretty robust. People need things. We're spending money. People are still making money. We can work remotely and generate remotely. A lot of people still have a lot of money, a lot of savings out there. There's a lot of people hurting and struggling too, but there's more people with more money now than there's ever been. Mm-hmm. And some of that's getting destroyed here lately, but it's bounced back nicely, and housing hasn't come down that much. So there's still a lot of wealth out there that has not been destroyed through this cycle. So that's going to keep pressure on things and keep the economy robust. So that's the soft landing that Powell is banking on. That's why he thinks he can land the plane softly here.
But it seems like they want to break something economically and then pivot.
The labor market. He's mainly after the labor market. That's where they really feel like they can affect inflation by reducing jobs, which correcting the imbalance in the labor market. There's too many jobs, not enough people. So if they reduce the amount of jobs out there, then that can kind of flip the balance. But I don't think they're going to be able to do that. I think this is a whole different paradigm now that they're not going to be able to affect that. So I think my thesis is we're going to see higher inflation. That's going to be a new norm. They haven't gotten there yet, but I think 3 to 4%. I don't know if we're going to get below that because of the way the labor market is.
Wow, interesting times, and hopefully not too painful.
Yeah. It's all good. These are all good things because wages are coming up. Inflation, costs are going to get a little bit higher, but wages are going to go up. We're having to make more things, and we'll have to make more things in the country as deglobalization continues to kind of set in. And, things will kind of balance out. Stuff will get more expensive, but we're all making more money. And that's kind of the history of the economy in this country, right?
Yeah, that's true. Very true. Yeah. When you look at it from a macro perspective, historically, that's been the cycle. Inflation, people earn more money, and the bucket keeps getting kicked down the road, I guess.
Yeah. And that's why the whole debate of the 2% inflation number, is that even an appropriate number where we are as a global economy right now? And that's why Powell said we're sticking with 2, because right now they're not buying that narrative that, we need to raise that target. And not sure what that would have done to the markets if he would have indicated anything other than we're sticking with 2%. So it's pretty interesting times. But for me personally, in my life, I'm in a different stage. I'm in preservation of capital mode, 55. I've worked a long time for what I have. And so I'm preserving wealth. I'm not taking, exorbitant risk. So when it comes to real estate market, when it comes to, equities and cryptos, I'm very careful, very risk averse in what I'm doing. So what I'm doing, what works for me is not for everybody. Like, you're younger, you can take more risk. You've got a lot more years to recover if you make some bad moves. And people are living longer, but I'm just assuming, I don't want to have to. I don't want to have to recover.
Right.
I like my life and I like what I'm doing. Now, what I'm excited about, what I'm doing a lot of is businesses and companies. So I'm involved in some companies that a couple of tech companies, internet companies,
As
things
an
like
equity
that.
investor.
Yeah, but from an intellectual capital standpoint,
Ah,
so I'm exchanging, intellectual capital and experience for equity in some companies and businesses right now. So that's kind of what I'm having fun with and excited about. And I have my own education company as well. I'm expanding that, doing some things. So those are the types of things I'm more excited about. Real estate, for me right now, it's not that exciting. I've done a lot of that, been there, done that. I enjoy teaching other people and helping them do that. But like I said, you can tie yourself up on a real estate deal for a long time, and I'm not interested in doing that right now.
yeah, yeah. I don't blame you, Greg. Always great information, man. Thank you so much.
Yeah, it was great to be here. Good to see you.